Hi class, so I hope you finished working on this practice problem we left with from the last video, chapter 10, part 2. We have 3 groups of information from this question, so we can solve for cost of common equity by using the 3 commonly used methods and take the difference between the highest and lowest estimates. Okay, let's look at the solutions if you have already finished the question on your own. Otherwise, you can pause the video now and keep working on this question. But if you're finished, you can proceed with me to look at the solutions. The first method is to use CAPM model to determine cost of common equity, RS. It should be equal to risk-free rate plus market risk premium multiplied by beta. We're given by the question that risk-free rate is 5%, market risk premium is 6%, RM minus RRF, market return minus risk-free rate. Beta is 1.25, so we can just plug the numbers into the CAPM model. The cost of common equity should be 12.5%. For the second method, we can use the dividend discount model constant growth model version to determine cost of common equity. RS becomes D1 over P0 plus G. D1 is 1.2, P0 is 35, G is 8%, given by the question. So we can just plug the numbers in. We should get 11.43% as our cost of common equity. The last method is to use bond yield or bond return plus risk premium. So RS becomes cost of debts. Again, this should be the before tax cost of debts, 7%, plus the stock over bond risk premium, 4%, given by the question. So we have 11% as our cost for common equity. Okay, so our maximum estimate will be 12.5%. Our lowest estimate is 11%. So the difference between them would be 1.5%. Okay, so these are the 3 ways of calculating cost of common equity. But what if we're not only calculating cost of common equity for retained earnings? What if we're calculating cost of common equity for new equity issues? Then we have to add flotation cost. Okay, because cost of retained earnings is cheaper than the cost of issuing new stock. Because when a company issues new common stock, they also have this additional flotation cost to the underwriter. Flotation costs are incurred by a publicly traded company when it issues new securities and includes expenses such as underwriting fees, legal fees, and registration fees. Issuing new common stock may also send a negative signal to the capital markets, which may depress the stock price. Okay, so we have this flotation cost because when the firm issues a new equity, on one hand, there are fees and expenses. On the other hand, this shows investors that the firm is in need of money. This may hurt investors' confidence in this firm. So the stock price will decrease because of the new issuing. This is why we have flotation cost. This is also why when we are calculating cost of common equity for new common stock, we are going to use the stock price P0 multiplied by 1 minus F flotation cost, because we think the stock price is going to go down because of this new issue. Okay, so F flotation cost looks like a discount rate here. The stock price decrease, and F is the decreasing rate or the discount rate for the stock price. Okay, when we were calculating cost of common stock for retained earnings, RS equals D0 multiplied by 1 plus G over P0 plus G based on the constant growth model. It is also D1 over P0 plus G. Here, we make only one tiny change here, that we add P0 multiplied by 1 minus F to the denominator here. Okay, so we're still using the constant growth model, but RE, the cost of new common stock, becomes D1 over P0 multiplied by 1 minus F plus G. This is our new formula, and we can derive this formula based on the original formula for calculating cost of common equity. For new issue, we add multiply 1 minus T to P0 because stock price decreases due to this new issue. Okay, so if issuing a new stock occurs a flotation cost of 15% of proceeds, what is RE? So we go back to the Coleman technology, our original example. So we know D0, G, and P0 for that firm. We also know FP here is 15%. Based on the new formula, we're going to use D0, 4.19, multiplied by 1 plus G, 1 plus 5%, divided by P0, $50, multiplied by 1 minus 15%, 1 minus F plus G. So we have 15.4% as our cost of raising new capital, which is higher than the cost of common equity using retained earnings, 13.8%. Flotation costs depend on the firm's risk and the type of capital being raised. They are highest for common equity. However, since most firms issue equity infrequently, the per project cost is fairly small. We will frequently ignore flotation costs when calculating the WACC. Okay, so when we are asked to calculate cost of issuing a new stock RE, we have to add the flotation cost. But when we're calculating WACC, we may ignore it because it's very uncommon for a firm to issue new stock, very infrequent. Okay, so for the original firm, Coleman, so far we've calculated its cost of debts, cost of common equity, and cost of preferred stock. Let's now calculate WACC for this firm, Coleman Technologies. For after-tax cost of debts or after-tax yield to maturity, we already know it is the before-tax cost of debts, 10%, multiplied by 1 minus T, 1 minus 40%. So we have 6% as after-tax cost of debt. For cost of preferred stock, it is the dividend of the preferred stock divided by price of the preferred stock. So we have $10 divided by 111.1. So we have 9%. For cost of common equity, the average of the three estimates is 14%. Tax rate is 40%. So WACC here should be WD, the WP, WC, the weight for debt, weight for preferred stock, weight for common equity, the target weights given by the question, which are 30%, 10%, 60%, multiplying by the three cost of components that we calculated. For RD cost of debts, it should be 10%, but we do need to do a tax adjustment, 1 minus T, so it's 10% multiplied by 1 minus 40%, or 10% multiplied by 60%, so we have 6%. For RP, it's 9%. For RS, it's 14%. So we use the three weights multiplied by three returns. We have WACC as 11.1%. Okay, so for this firm, Coleman Technology, we start from calculating cost of debts, and then after-tax cost of debt, RD multiplied by 1 minus T. We also calculated RP, calculated RS, then we use the three numbers multiplied by the target's capital structure or the target weights. So we have the final WACC. There are factors influencing a firm's composite WACC. There are factors the firm cannot control, such as market conditions, such as interest rates and tax rates. But there are factors the firm can control. For the outside environment, the tax rates and interest rates are hard to control, but the firm can decide its own capital structure, so it can decide the weights. The firm can decide on its dividend policy, so that will affect cost of preferred stock. The firm can also change its investment policy, so that can affect cost of common equity. Firms with riskier projects generally have a higher WACC because the higher risk, the higher return, or the higher cost. Question: should the firm use the composite WACC as the hurdle rate for each of its projects? No. The composite WACC reflects the risk of an average project undertaken by the firm. Therefore, the WACC only represents the hurdle rate for a typical project with average risk. Different projects have different risks, so the project's WACC should be adjusted to reflect the project's risk. Okay, so this is saying that the general WACC we just calculated, for example, for firm A, if it has a composite WACC of 10%, this is the cost of capital. This is the weighted average cost of capital for the firm for an average project for the firm. Okay, because we take the weighted average of all the component costs. However, if we want to evaluate projects and to see if their returns are higher than the cost, we should adjust our WACC from the flat line to this upward sloping line. Okay, because for different projects, we have different WACC. Okay, for riskier projects, we would have riskier WACC. For less risky projects, we have lower WACC. Okay, so this adjusted WACC is the minimum required return for the project. Any projects above the line means the rate of return for the project is higher than the cost for projects at this risk level. Okay, so we would accept any project above or on the line. Any project below the line tells us that its return is below the risk level. Any project below the line tells us its rate of return is below the cost for the risk at that risk level. Okay, for example, at risk level L, low risk level, if we have a project L with return of 9%, okay, and for this risk level, the cost of raising capital is 7%, okay, because the risk is low, so the cost is low, 7%. So for project L, we should accept it because the return is higher than the cost. We cannot compare the return of project L to the composite WACC 10%. Okay, because for projects with little risk like this, we actually have a lower cost, lower than the average cost for average project, 10%. For another case, when risk is as high at the risk high level, if we have a project H with a return of 11%, even though the return is higher than the average cost of capital, 10%, however, if we compare to the cost at this risk level, it's actually 13%. So the return 11% for project H is less than the cost of raising capital for projects at this high risk level, 13%. So we should reject project H. Okay, so if when we're looking at the projects, we should always look at the adjusted WACC line. It's higher for projects with higher risk, lower for projects with lower risk. So we can make the right decisions. We cannot use the same composite WACC for all the projects with all the risk levels. We would make wrong decisions if we do that. Okay, so if company didn't risk adjust and instead use the composite WACC for all projects, it would mistakenly select project H and reject L because H is above the composite line, L is below the composite line. However, if the company correctly risk adjusted the WACC, then it would select project L because it's higher than the adjusted WACC and reject project H because it's lower than the adjusted WACC. So of course, we should do what is stated in the second graph here, which is a better, wiser, right decision. Okay, we should always use the risk-adjusted WACC line to make decisions. Let's look at another practice problems here. We have a firm that has a perpetual preferred stock selling for 97.5 per share, and it pays an 8.5 annual dividend. If the company were to sell a new preferred issue, it would incur flotation cost F as 4% of the price paid by investors. What is the company's cost of preferred stock for using in calculations the WACC? So here we want to know cost of preferred stock, but it's a new preferred stock. Okay, remember when we were calculating cost of new issue of common equity, we add 1 minus F to P0 from the original constant growth model. So here, if we want to calculate cost of preferred stock, RP is DP, dividend of preferred stock, divided by price of dividends, price of preferred stock, PP. But here, because it's a new issue, RP would become DP over PP multiplied by 1 minus F. We're doing the same thing here. We are multiplying 1 minus F, take a flotation cost for the price of the preferred stock. Okay, and then because we know the stock price, dividend, and F, just plug the numbers in, we would have 9.08%. Okay, so now we know the cost of new stock for common stock, RE, and for preferred stock, RP. Okay, for both of them, we just add 1 minus F to P. Okay, so let's look at the last practice in chapter 10 here in the notes. This firm is expected to pay a $2.5 dividend at year-end D1. So D1 equals 2.5. The dividend is expected to grow at a constant rate 5.5% a year. So G, the constant growth rate, is 5.5%. The common stock currently sells for 52.5 a share. So P0, the current price, is 52.5. The before tax cost of debt, RD, is 7.5%. Tax rate, 40%. T. Target capital structure. Weight for debt is 45%. Weight for common equity, WC, is 55%. What is the firm's WACC if all the equity used is from retained earnings? Okay, so we don't have to worry about new stock here. And we only have debt and common equity here, so we don't need to worry about preferred stock either. Again, I would recommend you to pause the video now, just looking at the question here, and please do not look at the solution first, just look at the question here and work on this question on your own before we discuss about the solutions. Okay, so I will leave 10 to 30 seconds here in the video blank as well. You could also pause the video and we will discuss the solutions soon. Okay, so if you need more time working on this question, you can keep pausing the video. Otherwise, we could proceed to look at the solutions. First, we can use our constant growth model version of the dividend discount model or discounted cash flow model to determine cost of common equity RS. It should be equal to D1 over P0 plus G. And we know here that D1, P0, and G, they're all given. So we can just plug the numbers in. We have 10.26% as cost of common equity. For cost of debt, we know the before tax cost of debt is 7.5%. The tax rate is given as 40%. So after tax cost of debt becomes RD multiplied by 1 minus T. So it's 7.5% multiplied by 1 minus 40%. So we have 4.5% as after tax cost of debt. Okay, and we know WD, cost weight for debt, is 45%. WC, weight for common equity, is 55%. So WACC becomes WD, weight for debt, multiplied by after-tax cost of debt, okay, plus weight for common equity, WC, multiplied by cost of common equity, RS. So we use WD 45% multiplied by 4.5% after tax cost of debt plus 55% weight for common equity multiplied by cost of common equity 10.26%. So the final WACC becomes 7.67% for this firm. Okay, so this is all about chapter 10. After this chapter, you should be able to know how to calculate cost of debt, cost of common equity, and cost of preferred stock for new stocks or for retained earnings. And also calculate WACC by taking the weighted average of all the component costs. Okay, please also remember, because we're supposed to finish chapter 10 on April 7th and 9th, so your homework for chapter 10 will be due on April 16th. Okay, and for chapter 9, we were supposed to finish it on April 2nd, so homework for chapter 9 would be due on April 9th. All right, and homework for chapter 8 will be due on April 2nd. I hope you plan your time well already for digesting all the materials in the notes and watch videos, and also plan for working on the homeworks as well. And lastly, please remember to leave a comment or a summary of what you have learned in each module in the discussion board. So I know that you are keeping your work on this class. Okay, that's a way of taking attendance and participation in this class. Okay, so I will discuss with you more in the next video and also on the discussion board.